Investors are always looking for ways to manage risk and maximize returns in the stock market. Options contracts offer a unique way to achieve both. These contracts give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price. This flexibility makes options a valuable tool for both hedging against potential losses and speculating on future price movements. Options contracts are like side bets on a sporting event. Imagine you believe your favorite team will win their upcoming game. You could place a bet with a friend, agreeing to pay them a small amount if the team loses, but receiving a larger amount if the team wins. In this analogy, the bet is the options contract, and the team winning represents the underlying asset's price moving in the desired direction. Just like in sports betting, options trading involves risk, but it can also lead to significant rewards if done correctly. Whether you're a seasoned investor or just starting, understanding options contracts can open up a world of possibilities for managing your portfolio. In the following sections, we'll delve deeper into the world of options, exploring key concepts, different types of options, and strategies for success. Before diving into the specifics of options trading, it's crucial to grasp some key terms that are fundamental to understanding how these contracts work. These terms form the building blocks of options trading and are essential for navigating the complexities of this financial instrument. Strike price. This is the predetermined price at which the underlying asset can be bought or sold when exercising an option. Think of it as the price agreed upon in our sports betting analogy. Spot price. This refers to the current market price of the underlying asset. It's the price you'd pay if you bought the asset directly from the market at that moment. Premium. This is the price you pay to purchase an options contract. It's like the upfront cost of placing your bet. The premium is influenced by factors like the strike price, time to expiry, and market volatility. Expiry date. This is the date on which an options contract expires. After this date, the contract is no longer valid. It's like the deadline for your sports bet. Understanding these terms is like learning the basic rules of a game. Once you're familiar with them, you can start to understand the strategies and nuances of options trading. Now that we've covered the basics, let's dive into the two main types of options contracts: call options and put options. A call option gives the buyer the right, but not the obligation, to buy the underlying asset at the strike price before the expiry date. Buyers purchase call options when they anticipate the underlying asset's price will rise. They're essentially betting that the asset's market price will exceed the strike price, allowing them to buy it at a discount and potentially profit from the difference. Let's illustrate this with an example. Imagine you're bullish on Apple stock, AAPL. The current spot price is $150, but you believe it will go up to $170 in the next month. You could buy a call option with a strike price of $160 and an expiry date 1 month out. If the price of AAPL goes up to $170 as you predicted, you can exercise your option, buying AAPL at $160 and immediately selling it at the market price of $170, making a $10 profit per share. However, if the price of AAPL stays below the strike price of $160, you would let the option expire, losing only the premium you paid for the contract. This limited risk feature is one of the attractive aspects of options trading. On the other hand, put options are the opposite of call options. A put option gives the buyer the right, but not the obligation, to sell the underlying asset at the strike price before the expiry date. Put options are typically purchased when the buyer anticipates a decrease in the underlying asset's price. Let's say you're bearish on Tesla stock, TSLA. The current spot price is $250, but you believe it will drop to $220 in the next month. You could buy a put option with a strike price of $240 and an expiry date 1 month out. If TSLA's price drops to $220 as you predicted, your put option allows you to sell your shares at the higher strike price of $240, profiting from the difference. However, if TSLA's price remains above the strike price, you would let the option expire, and your loss would be limited to the premium paid for the put option. Section 5. Differentiating call and put options. The key difference between call and put options lies in the buyer's market outlook and the direction they anticipate the underlying asset's price moving. Call options are bullish bets, while put options are bearish bets. Call option buyers believe the underlying asset's price will rise above the strike price, while put option buyers believe it will fall below the strike price. Both options provide the buyer with the right, but not the obligation, to buy or sell the underlying asset respectively at the strike price before the expiry date. To summarize, call options are bullish, betting on a price increase, and give the right to buy. Put options are bearish, betting on a price decrease, and give the right to sell. Understanding this fundamental difference is crucial for choosing the right option strategy based on your market outlook and risk tolerance. Section 6. The importance of stock analysis. Before diving headfirst into the world of options trading, it's crucial to have a solid understanding of stock analysis. This involves evaluating a company's financial health, industry trends, and overall market conditions to make informed investment decisions. Stock analysis is like doing your homework before placing a bet. It helps you understand the odds, assess the risks, and make more informed decisions. Just as a sports bettor would research team statistics, player injuries, and recent performance, a savvy investor analyzes a company's fundamentals and technicals before putting their money on the line. There are two primary methods of stock analysis: fundamental analysis and technical analysis. Both approaches offer valuable insights into a company's potential, and combining them can provide a well-rounded perspective on investment opportunities. Section 7. Fundamental analysis and key metrics. Fundamental analysis involves digging deep into a company's financial statements, evaluating its management team, and understanding its competitive landscape. It's like examining the foundation of a house to determine its stability and value. Key metrics used in fundamental analysis include earnings per share, or EPS. This metric measures a company's profitability by dividing its net income by the number of outstanding shares. Higher EPS generally indicates a more profitable company. Next is the price-to-earnings ratio, or PE. This ratio compares a company's stock price to its earnings per share. It gives investors an idea of how much they're paying for each dollar of earnings. And then we have dividend yield. This metric shows how much a company pays out in dividends each year relative to its share price. It's an important consideration for income-seeking investors. By carefully scrutinizing these and other fundamental factors, investors can gain a deeper understanding of a company's intrinsic value and its potential for future growth. Section 8. Technical analysis and its assumptions. While fundamental analysis focuses on a company's intrinsic value, technical analysis takes a different approach. It involves studying historical price and volume data to identify patterns and trends that can predict future price movements. Technical analysts believe that market psychology and investor sentiment play a significant role in driving stock prices. They use charts, indicators, and other tools to decipher these patterns and make trading decisions based on probabilities. Key assumptions of technical analysis include market everything discounts. This principle suggests that all relevant information is already reflected in a security's price. Prices move in trends. Technical analysts believe that prices tend to move in trends and these trends persist over time. History repeats itself. This assumption suggests that market participants tend to react to similar events in predictable ways, leading to recurring patterns in price movements. While technical analysis can be a powerful tool, it's essential to use it in conjunction with fundamental analysis and risk management techniques. Section 9. Tips for successful intraday trading. Intraday trading, as the name suggests, involves buying and selling securities within the same trading day. It's a fast-paced and potentially lucrative endeavor, but it also carries a higher degree of risk. Here are some tips for successful intraday trading. Choose liquid stocks. Liquidity refers to how easily a security can be bought or sold without significantly impacting its price. Trading highly liquid stocks ensures you can enter and exit positions quickly without incurring excessive slippage. Practice risk management. Setting clear profit targets and stop-loss orders is crucial for managing risk in intraday trading. These orders automatically execute trades when the price reaches a predetermined level, limiting potential losses. Stay disciplined. Emotional trading can be detrimental to your success. Stick to your trading plan, avoid chasing losses, and don't let greed cloud your judgment. Conduct thorough research. Before trading any stock, thoroughly research its fundamentals, recent news, and potential catalysts. Understanding the factors driving price movements can give you an edge in the market. Intraday trading can be rewarding for those who approach it with discipline, knowledge, and a well-defined strategy. Remember to start small, manage your risk, and continuously learn and adapt to the ever-changing market dynamics.